Most people think government debt works like household debt. Borrow too much and eventually you run out of options. So when headlines say the United States carries tens of trillions of dollars in debt, the conclusion seems obvious: this can't end well. But what if the most important part of the story isn't the size of the debt? What if the real strategy isn't about paying it down at all? The mystery isn't why U.S. debt keeps rising. The mystery is why the system still works and who it quietly benefits. Setting the stage, why U.S. debt is different. To understand America's debt, we need to understand one uncomfortable fact. The United States doesn't borrow like other countries. Most nations borrow in currencies they don't control. The U.S. borrows in its own currency, the same currency the global system depends on. That single difference changes everything. It means U.S. debt is not just a financial obligation. It's a structural feature of the global economy. And once you see that, the strategy begins to reveal itself. Origins: debt as a tool, not a problem. U.S. debt didn't start as a crisis. It started as a tool. During World War II, the U.S. issued massive amounts of debt to fund production, mobilization, and global leadership. The economy expanded faster than the debt itself. After the war, instead of shrinking, the system evolved. The dollar became central to global trade. U.S. government bonds became the world's safest asset. Foreign countries began holding U.S. debt not out of charity but necessity. Debt wasn't just tolerated. It was absorbed by the global system. That was the foundation. The rise. When borrowing became a feature over time, something unusual happened. Global trade expanded. The world needed more dollars. To supply those dollars, the U.S. had to run deficits. In other words, U.S. debt became the mechanism that supplied global liquidity. This flipped the traditional logic of borrowing. Normally, debt weakens a country. But in this system, debt strengthened America's influence. Foreign governments recycled trade surpluses back into U.S. Treasury bonds. Those bonds funded U.S. spending. U.S. spending sustained global demand. It became a loop. And as long as the loop held, rising debt wasn't a flaw, it was a requirement. The breaking point, when scale became a risk, but systems change when scale changes. Over the past 2 decades, U.S. debt growth accelerated dramatically. Financial crises, stimulus programs, and emergency interventions pushed borrowing into territory never seen before. At this level, traditional solutions stopped working. Raising taxes couldn't keep up, cutting spending became politically impossible, paying down debt outright was no longer realistic. So the strategy shifted, not officially, not publicly, but structurally. Instead of reducing debt, the system began managing it. The hidden strategy: managing debt without saying so. Here's the part few people talk about openly. The real U.S. debt strategy isn't repayment. It's time, inflation, and control of the system around the debt. Debt is extended rather than eliminated. Inflation slowly reduces real value. Low-interest environments limit servicing costs. Meanwhile, the global demand for safe assets ensures buyers remain. This isn't a conspiracy, it's an incentive structure. No single law declares it. No politician announces it. But the system behaves as if debt is meant to be rolled forward indefinitely, not cleared. Fallout: who pays the quiet cost? This strategy has consequences. Debt doesn't disappear. Its cost is redistributed. Inflation reduces purchasing power. Asset prices rise faster than wages. Savings lose real value. Domestically, inequality widens. Internationally, countries holding dollars absorb part of the burden. The system remains stable but not neutral. And stability often hides imbalance. Failed fixes: why alternatives keep stalling? Many reforms have been proposed. Fiscal discipline, debt ceilings, balanced budgets. But each fix runs into the same reality. The global system now depends on U.S. debt. Reducing it too quickly risks liquidity shortages, market instability, global recession, so fixes become symbolic. Debates repeat. Debt keeps rising. Not because leaders are unaware, but because the system is locked in. Modern parallels. History rhymes again. History shows this pattern before. Britain financed empire through debt when the pound dominated trade. As dominance faded, debt became heavier. The difference today is scale. The US dollar is embedded deeper into global finance than any currency in history. Which means the strategy lasts longer, but adjustments hit harder. Debt doesn't end empires overnight. It reshapes them slowly. What this means going forward: the hidden strategy isn't about default or collapse. It's about stretching time. keeping the system functional long enough for gradual adjustment, whether through inflation, growth, or geopolitical shifts. The risk isn't sudden failure, it's slow erosion of trust. And trust, once lost, is hard to restore. 3 key takeaways. First, U.S. debt functions differently because it sits at the center of the global financial system. Second, the real strategy isn't repayment but management through time, inflation, and global demand. Third, the costs of this strategy are spread quietly across societies and borders, making them harder to see and harder to debate. Final thought. The most powerful strategies are the ones no one has to announce. U.S. debt isn't just a number. It's a system. And systems don't collapse when people argue about them. They change when people stop believing in them. If you want more deep analysis on hidden financial mechanics, global power, and the forces shaping the future, subscribe to the channel. Because the most important economic strategies aren't written in speeches. They're written into how the system behaves every single day.